Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. My co-hosts, Mark Hanf and Nam Fon, are off today, but we are going to introduce a special guest in just a minute here. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. And that certificate's not sponsored by the radio station, but by Tanvella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is literature. Now, today we have a special guest. And I would say it's extra special because it's during tax season and he's taking time off from his busy schedule. His name is Jeff Badu from Badu Tax Services to discuss tax tips specifically for real estate investors, which would be awesome. I'm going to read a little bit and then I'll introduce him personally here. So Jeff is a parallel entrepreneur and wealth multiplier. He's a licensed CPA and the founder and CEO of Badu Enterprises, LLC, which is a multinational conglomerate that owns several key companies. His marquee company is Badu Tax Services, LLC, which is a CPA firm that specializes in tax preparation, tax planning, tax representation for individuals and businesses. Another key company is Badu Investments, LLC, which is a real estate investment company that acquires residential and commercial rental real estate properties in areas such as the south side of Chicago in efforts to restore traditionally underserved areas. Jeff, welcome to The Best of Investing. How are you?
Doing good, Ed. How you doing?
Good. Yeah, Edward Brown here. Okay, so I have, first of all, I want to thank you very much because I know that as we were talking just off the air, I used to do 200 tax returns myself. And during tax season, nobody bothered me, so I really appreciate the fact this show is going to air on April 1st. And I got to think that's just a really, really busy time. First of all, how many tax returns do you prepare?
So our firm, we have a team of 25 people currently.
Oh, wow. Okay.
And we we do about 2,000 tax returns a year. And in our database, we have about 3,000 clients.
Wow.
That, on and off types of services, essentially.
That's awesome. I really appreciate it. One thing before we get into the nuts and bolts of stuff, it says here, you specialize in the south side of Chicago, which, I think most people know is a little bit more of the rougher areas of the country. And it kind of reminds me, because we're talking about the real estate side of it, during the 2008 crisis, here in California, Oakland, has the reputation of being, a little bit kind of a more dangerous neighborhood. And a lot of the banks wouldn't go into those areas and lend. And so it took alternative companies like Pacific Private Money here in California to go ahead and lend to real estate not developers, but, fix and flippers and that sort of thing back then. So I'm wondering, is it sort of the same sort of thing with you guys?
In general, Chicago, I would say it's pretty developed. It's a lot of, in general, there's still a lot of room for growth. Mm-hmm. But overall, a lot of the neighborhoods are very well developed.
Okay.
There are a few that are, a bit distressed and need some work, need some renovations.
Sure.
But yeah, overall, Chicago, I would say is definitely looking promising, and we're definitely on the up and up.
Yeah, we bought. I helped a company buy a discounted mortgage in Chicago, and just about 2 months ago, we sold the property. It was a gentle foreclosure, and we sold the property, and we did really well on it. So there's definitely a lot of stuff there. So let's talk about the tax aspect, because I know a lot of the audience is going, "Hey, tax season! Let's see if we can get some advice here." So first of all, what is the best entity that you found to structure for tax purposes?
The best entity type, I would say, would be. In terms of an active, right? So for your active income, your day-to-day, your main hustle, right? Whether you're a real estate agent, attorney, contractor, accountant. Mm-hmm. I usually say an LLC, limited liability company, that is taxed as an S corporation.
Okay.
That tends to be the sweet one, just because you get the asset protection, right? They can't sue you and take what you own personally if you're doing things in a business name. And then with the S corporation, it allows you to prevent the self-employment tax. right? The 15.3% FICA, Social Security, or self-employment tax, at least on your profit. Anything that you don't run through W-2 payroll. So you're literally able to save on a self-employment tax, which effectively comes out to about 10% of your profit. So if you're making, you know, 150,000 in revenue and you have $50,000 in expenses, that means you have $100,000 net profit. Now you're able to put an extra $10,000 in your bank account by certainly avoiding the self-employment tax, right, that you would have paid had you been a regular LLC tax as a sole proprietorship. Okay. But now by moving to that S Corp tax structure, now you all of a sudden save on Social Security taxes. Right.
Okay, so we're gonna continue on with that. We got to go to a quick break. These segments go pretty fast here. First trivia question here is, what book written in 1954 is about schoolboys on an uninhabited island, which has characters such as Jack and Piggy? Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Stay with us. You're listening to The Best of Investing. Don't touch that dial. We'll be right back. Welcome back to The Best of Investing. Edward Brown here along with my special guest, Jeff Badu, who is a CPA. First trivia question. What book written in 1954 is about schoolboys on an uninhabited island? If I remember correctly, I think it was because of a plane crash, which has characters such as Jack and Piggy. Any idea, Jeff? Not sure? Okay. I was going to say, we had to read that when I was a kid. Lord of the Flies. Okay. I want to make a quick mention here for the New Living Expo, which is going to be at the Marin Civic Center. Check them out, the New Living Expo. All right. So we were talking about having a corporation, LLC, you know, taxed as an S corporation. Where does it come in, though, where you still have to kind of pay yourself a salary versus just allowing all the profits to?
Yeah, that's a great question. So essentially, as an S corporation, as either an LLC taxed as an S corporation, or a corporation taxed as an S corporation, one of the nuances is you do have to run a W-2 payroll, right? As the owner of the business, you have to pay yourself a salary. And usually the rule of thumb that we do is we pay ourselves 25%, up to 25% of net profit. So if you made $100,000 net profit during the year, then we usually pay a small salary of $25,000. Okay. That $25,000 will be subject to the self-employment, the FICA taxes. Yeah. But now you're $75,000, let's say, in profit, remaining profit after the payroll, no FICA, no self-employment taxes. So you just save yourself about $7,500 essentially.
I like it. That's very, very good. And then you had, and again, I'm reading from a list of questions that you sent me. So hopefully you know this. Okay, so how can I keep my books organized? What do you suggest?
That's another great question. So I usually recommend QuickBooks.
Yeah.
So QuickBooks Online, right? You know, just getting the online version where you ultimately can link all of your bank accounts into one software.
Okay.
So your checking account, your savings account, your credit card account, and it's going to auto-populate your transactions, right? Let's say you're filing taxes for 2022. You can go back to January 1st, 2022 and pull all your transactions in the bank feed.
Yeah.
And ultimately, all you have to do is really categorize them and say, okay, this is meals, this is travel, this is home office. Best practice, keep up with it on a monthly basis, right? So log into your QuickBooks, reconcile, or, you know, just categorize the transactions. And then when you get to the point where you're like, you know what, I don't have the time for this, or I don't have the expertise, that's when you may want to hire a bookkeeper. And we do offer bookkeeping services through our company, Badu Bookkeeping LLC. So usually when businesses hit 6 figures in revenue, that's when they start thinking about maybe hiring a bookkeeper.
Yeah.
But nonetheless, it's completely up to you. I would say it's a gut check, but QuickBooks Online is your best friend for sure.
You know, it's funny. I got hooked up with Quicken back in the 90s. And finally I had to upgrade from a floppy disk to, but I'm still using Quicken from either 2002 or 2012 or whatever. And I like it. I mean, it's so easy to use. It's so, it's just perfect because you just, like you said, you just get everything categorized and then figure out what you need for tax purposes and all that.
Exactly.
Okay, so now let's talk about writing off on your taxes about being a real estate investor? Because there's various rules with active, passive, QBID, blah, blah, blah. Go ahead.
Absolutely. So basically, usually in your active business, right? So there's two sides of this. There's the active business and then there's the passive business. Okay. The active business is your day-to-day, your main hustle. The passive business is real estate, right? More so rental properties. Okay. So in your active business, you want to be writing things off, right? A write-off is something that is a business expense that helps reduce your overall taxable income. Okay. So on $150,000 in income, if you have $50,000 in expenses or write-offs, then that allows you to pay taxes only on $100,000 instead of $150,000, right? So you're putting more money in your bank account essentially. So when we talk about write-offs, things like laptop, right? When you buy a laptop and you're using it for business purposes, that's a tax deduction. Well, car, your automobile, when you're driving to and from business locations and client sites and all that, that's a tax deduction. Your cell phone, tax deduction. Your Apple Watch, tax deduction. AirPods that I'm using to, listen to this podcast, talk on this podcast, tax deduction.
So I like the fact that, okay, so like I know the IRS, their attitude is nothing's deductible unless we say specifically it is allowed, and take the opposite approach. Everything's deductible except for what, like specific food for your house. That's, for you and your children.
Exactly.
And then like for cars, in the old days, it used to be like if for leasing a car, you would write off the business portion, but then there was this thing called inclusion amount. Do they still have that?
No such thing right now.
So go ahead, and if you take 80% of, you use 80% of your business, you just write off 80% of the lease.
Exactly.
Gotcha.
Exactly.
Okay. And does that count for both open and closed-end leases? And for those who don't know, like let's say where you lease a car and at the end you only owe $1, effectively purchased it. So they consider that still a purchase, don't they?
Yeah, I mean it gets a little more complicated with that, but in general, you're gonna write off the lease payments while you're leasing the car. Okay. And then ultimately when you turn it into a purchase, then that's where you want to really strategize and determine how you're going to write off, that purchase of the car.
Okay, good. Well, what is I can't remember now. What's the Section 179 deduction now? It was like 250,000 or something.
Yeah. So cars. Honestly, we're more so using bonus depreciation nowadays, right? Which thanks to the Tax Cuts and Jobs Act in 2017, afforded used cars, used items to be bonus depreciated. Yeah. Nowadays, 179 is not super common. But, we're using the bonus depreciation where for a vehicle we can do, if it's an SUV or 6,000 plus.
Okay. I'm sorry. This went so fast. Anytime it comes to taxes, I just love it. So, okay. Second trivia question. What book written in 1851 is about a quest for a whale? Stay with us. The Best of Investing will be right back. Welcome back to the Best of Investing one more time. I'm Edward Brown, your host, along with my special guest, Jeff Badu, to talk about income taxes, everybody's favorite topic. What book written in 1851 is about a quest for a whale? What's the name of that book? That would be Moby Dick. For that one. Wow, Moby Dick, yeah. All right. I want to make a mention here also for Mountain Mike's Pizza in Santa Fe. Pizza the way it ought to be. Also, the Tahoe Lakeshore Lodge. They are right on the water in Tahoe. You got to check them out at lakeshorelodge.com. Take Tahoe lakeshorelodge.com. One other mention here is Petty Theft at the Mystic Theater in Petaluma on April 8th. It's a tribute band to Tom Petty and the Heartbreakers. All right, so Jeff, what's the biggest tax deduction in the tax code, and how can I take advantage of it?
Yeah, so this is where things get complicated, but it gets a little fun and exciting.
Okay.
Right. So the biggest deduction in the tax code is depreciation. Depreciation, right? Depreciation is the concept where I can take an asset such as a car, or actually, since we're talking real estate, I can take a real estate property and I can take the purchase price, subtract the land, and you can basically divide it by 27.5 years, right? Now, what I can do if I'm what we call a real estate professional, someone who does real estate day to day, or I own a lot of properties, I can take basically up to 25% of the purchase price of the building as a deduction in year one of owning the building or utilizing it for rental purposes, right?
Wow.
So in the example of 150,000 in business revenue, if I got $50,000 in expenses, then that means I'm left with $100,000 in profit.
Yeah.
Well, if I'm a real estate agent who's deemed a real estate professional, I can go out and buy a rental property. Let's say I buy it for 400,000. I can claim a tax deduction of 25% of that, which is $100,000, by accelerating the depreciation through a strategy called cost segregation. And so $100,000 profit on my active business side minus $100,000 depreciation deduction on my passive business side equals zero taxes due.
That's awesome. Now, do you actually have to go through the cost segregation where, you know, you divide up like this much for handles on the door and stuff like that? Or, do you actually have to do that, or is it just an automatic bonus depreciation of 25%?
So according to the IRS code, you do have to go through a cost segregation study.
Gotcha.
You know, and we do partner with, you know, cost segregation study companies, engineers, professional engineers that go out to the property, study the property, and they'll give you this nice long report that you can attach to your tax return. And that effectively gives you the bonus depreciation on the property.
And what kind of things qualify for that cost segregation generally?
Yeah, I mean, pretty much everything that's not sort of foundational to the property. So doors, right? Fixtures, cabinets, you know, even like the AC, the air conditioning that can go out every so often.
Yeah.
Even nowadays, certain flooring, even a roof can count, you know, so pretty much everything except for, you know, the bricks that's on the building itself and the foundation, that can be counted as bonus or component depreciation.
You know, it's funny. It's so, in the old days, it used to be just, you know, you had the land, you had the building, and it was only the furniture and fixture, you know, furniture that you could do. Without going into all those expenses of cost segregation, why don't they just go ahead and just give you roughly, you know, make a number, 25% or whatever. Right. You know, it's too complicated to figure out, you know, yeah, we've got 14 doors and 3 handles, but there's 2 locks on this one. And, you know, I mean, they just drive you batty. I'm asking you to give advice as to why the IRS does this stuff, your Congress. What are 3 questions you should ask a tax professional before working with them? That's a good one.
Yeah, I mean, that's a very important question because, you know, this is all about building relationships and we're all about working with the right people. Yeah. So the first question I would say is, you know, what type of clients do you work with? Right. It's a very important question because you want them to be working with clients that are like yourself. So if you're a real estate investor, you probably want a real estate CPA, right? And we specialize in real estate taxes. Okay. The second question is how much experience do you have, right? How much experience do you have? And along with that is how many people on your team? It's a very important question because a lot of accountants are a one-man, one-woman shop.
Sure.
And if God forbid something happens to them, well, guess what? They're done, right? It's like some people are keeping their documents and all of a sudden you can't get a hold of them. And last but not least, the most important question is what is your personal tax strategy?
Yeah, there you go. I like that one. Yeah, in fact, when, you know, me, I was a one-man shop, and sometimes I'd get questions, and I say, you know what, I don't know the answer to that. I'm gonna have to look it up. You know, you don't charge for that, but still, it's better to go with a firm that has more people to. Tell you what, we're gonna cut to our 3rd trivia question here. What book written in 1939 is about a family who migrates to California during the Depression? They also made a movie out of this. I think Henry Fonda was in it. Call 888-912-1190. First caller with the correct answer wins the tanning certificate, which is worth $100. Stay with us. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown along with Jeff Badu here. 3rd trivia question. What book written in 1939 is about a family who migrates to California during the Depression? Any idea? Not on that one either? Okay, I know. I'm not a big literature fan. But, you know, it's funny. Last week, I think I asked baseball questions. Grapes of Wrath was that one there.
Wow.
I know because I've got the answers here. Otherwise, I'd be kind of throwing out my hands too. All right. So, Jeff, what last little bit of advice would you give us for, I know that, for people who are either on extension or close to it, if they're self-employed, they can do a SEP IRA. If they're going to do a regular IRA, don't they say regular IRAs, do they still need to do it by April? I think it's 18th this year.
Yep. That's
or
right.
17th or whatever. Because 15th falls on a Saturday, so they'll push it over.
Exactly.
Do you still have to do an IRA by quote April 15th, or do
yes.
they? Okay,
that is correct. Yeah, you still get until the deadline to do that.
Okay, so that's for an IRA. But if you're self-employed, you can do a SEP IRA or KEO or pension plan, all that, and that you can do with an extension. Besides doing that kind of retirement plan, any other specific advice that you can give people? I mean, I know it's after December 31st. Is there anything that people can do between, January, like right now, between now and tax time?
Yeah, it's a great question. I'll give you three tips. Okay. Number one, yes, the IRA is a great tool. I usually recommend the Roth IRA, the after tax. Okay. Because tax rates are probably going to go up in the future. The money grows tax-free in the Roth, and then also you don't pay any income taxes when you take the money out. Okay. So that's one. Number two is the HSA, the Health Savings Account, which allows you to put, about $3,600, $3,700 or so every year. If you're single, if you're married, you can put up to about $7,500 or so. And
can you do that after December 31st?
Yeah, you can do. You have until April 18th to do it.
Okay, so it's like an IRA from that end of it. Okay, exactly. Yeah, those are great.
Yeah, so I mean, basically, you get a tax deduction up front, whatever you put in. The money grows tax free. It can be invested into stocks, index funds, mutual funds, and then when you take the money out for retirement, you don't have to pay any taxes on it. Right.
Yeah, and those are two. So the HSAs are supposed to be used to reimburse you for medical expenses.
Correct.
Especially if you're under 59 and a half. If you're over 59 and a half, and I guess what you would just pay, would you pay tax on the money coming out if it's not used for medical, but there's no penalty?
That is exactly correct.
Okay, so it's just like a big IRA. I mean, I know I funded my HSA every year you always have some medical expenses that you can charge against it, but I like to keep that bucket tax deferred for a very long time if I can. Now, you know what? I got to say one quick thing about the Roth IRA, and this is just my prediction, okay? Because way back in the 80s, I predicted that they were going to tax Social Security, and everybody told me I was crazy. And I said, no, they're going to tax it, okay? With the Roth, I don't think they're going to come right out and say, well, we changed our mind, and we're going to start taxing it. But what I think they're going to do is if too much money, if Roths are too big in the country, I think what they're going to do is the IRS is going to say, just like what they did with private activity bonds for municipal bonds, you don't have to pay taxes on it, but you have to report it. And when you report it, they'll say, well, because you made too much money in your Roth, now we're going to tax your Social Security, 100%, or we're going to have extra taxes on something else, so that it kind of, somewhat balanced out. Again, that's my prediction. And shh, Congress, don't be watching the show. Don't listen. Don't take my advice. I'm just saying that's my prediction. You said you have one more piece of advice for us.
Yeah. So, and this I usually say the best for last, right? So, number one, the IRS is your partner. The IRS is your partner, in that when you do things, when you emulate certain behaviors, such as hiring people and putting people into housing, right? They're going to reward you for that. So that to me is a partner. That's somebody that I want to work with. So the IRS shouldn't be viewed as this bad guy or, Uncle Sam knocking heavy at your door or anything like that, right? It could be a friendly relationship, as long as you emulate behaviors that the IRS wants you to do. And then also the tax code was created for you, not against you, right? It was created for you, not against you, especially if you're a business owner and or a real estate investor. You're
the first one I've ever heard that from. I like that. That's a good. I like that piece of advice. And if people have questions for you personally, I'm sure it's going to be difficult to get a hold of you during tax season, but maybe they can, maybe they can't, but at least you can help them during the year if you can't help them right away. How would they get a hold of you?
Yeah, so the easiest way is to visit our website, badutaxservices.com. That's Badu, B-A-D-U, taxservices.com. So that's going to be the quickest, easiest way. If you're more of a phone person, just call us 773-819-5675. That's 773-819-5675. When you call, we will pick up within 10 seconds, literally every time. That's just how our model is set up, essentially.
I like that. You're not rerouted through 5 different channels throughout the country.
Exactly.
No, that's very good. Jeff, thank you so much. Hang out for a little bit. Where I'm going to talk for just a little bit about Pacific Private Money and what they're doing, and then we'll have no more trivia questions, but we'll have some closing comments when we come back. So Pacific Private Money is still making loans out there to real estate investors and also people wanting to buy personal residences. The interesting thing with all the Silicon Valley Bank and Signature Bank situation is I think that they're going to be even busier, because personally, I think that the government is going to look at and go, you know what, we've got to put more regulations on these banks. You look what they're doing. And when that happens, whenever there's more regulations, what ends up happening is it just becomes a better situation for the private lenders, of which Pacific Private Money is. So their rates have actually gone up. They're charging their borrowers more, but they're also paying their investors more. So for more information on them, pacificprivatemoney.com. They have like 4 or 5 different funds right now. They just opened up a new fund called the Opportunity Fund, where it's a REIT. And for those people who know about taxes, the REIT has the benefit of the QBID at the level of the REIT rather than the individual. So good old Jeff Bezos, if he's investing in a REIT, doesn't matter what his income is, he still gets the benefit of that 20% deduction of the distribution. So that's a good thing. Stay with us. The Best of Investing will be right back with some closing comments. Don't touch that dial. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my special guest, Jeff Badu, who was kind enough to take time out of his busy schedule during tax season. I mean, you can never get a hold of an accountant during tax season. So I really appreciate you coming on and helping our audience. Before I forget, also give out your information one more time so the audience can get a hold of you if they have any questions on real estate tax law or
Absolutely.
tax.
Absolutely. So yeah, easiest way to get to myself and my firm, our website, badutaxservices.com. That's badutaxservices.com, BADUTAXSERVICES.com. And then also you can call our phone. If you're more of a phone person, just call us 773-819-5675. That's 773-819-5675. And yes, we do pick up within 10 seconds of you calling.
I like that. And it's funny too, because your last name's so easy. Badu, B-A-D-U. Pretty simple. Just like, when I say brown, just like the color. Nice and simple. So it's funny. We have one fund which I just happen to be one of the managers of, is called the Pacific Southwest Note Fund. And that fund, right now, we're just paying a flat 8%. We buy discounted mortgages. The interesting thing there is it's very conservative, because the mortgages, the loan to value is only about 44%. And the investment value, because we're buying at a discount, is about 26%, 26 to 29%. So it's a very, very conservative fund, pays like clockwork every month. You can either take the distributions or reinvest it for a compounded yield of about 8.35%. $50,000 minimum. You do have to be, an accredited investor. So that definition is $1 million net worth, exclusive of your home, or $200,000 if income if you're single, $300,000 if you're married. The best part about it, I think, is the fact that even though there's technically a 1-year hold, we do not institute an early withdrawal penalty. So all you have to do is give us 30 days notice when you want your money back. And interestingly enough, I had a guy invest in December, and then he called like about less than a month ago, and he apologized. He said, "I'm so sorry. I need to take my money out. I know I shouldn't do that." I said, "Hey, it's your money." So it took us only about 3 weeks, rather than the full month to get him his money back. But he's happy as a clam, and he'll probably come back as an investor sometime. So for more information on that, check out pacificprivatemoney.com and look at our investment page, and you can see the various funds we have. The Freedom Fund pays anywhere from 7 to 9%, depending upon how much you invest. Makes short-term loans, pretty conservative. The way that they can offer the liquidity is the fact that they're doing loans, packaging them up, selling them to the big boys, getting the money back, putting it back on the conveyor belt, and start it all over again. And all of the funds do qualify for QBIT. So for those who don't know, for the non-REIT, you do have to have income. I think the number is 315,000, unless they changed it, or less. Then 20% is tax-free of whatever we pay. So if we paid you $10,000, you don't have to pay taxes on $8,000. If your income's way too high, then if you're in the REIT, which is the Opportunity Fund, which pays as high as 10%, they're making construction loans in that. It's a brand new fund. Then you qualify. You don't have to worry about your income side of it. So again, for more information, go to pacificprivatemoney.com. Last mention here, Mountain View Hotel and Spa in Calistoga, giving 25% off this season. Check them out. All right, ready for our thoughts for the day? George Bernard Shaw said, both optimists and pessimists contribute to society. The optimist invents the aeroplane, the pessimist, the parachute. And how excited was the gardener about spring? So excited he wet his plants. A little bit of dad humor in there. Okay, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.